Hello, Gavin McCormack here, and welcome to this week's episode of Financial Fundamentals, a course where you get to learn about the details of dealing with finance. Now this week, we're going to ask you to step into the shoes of Mr. Stevenson. Now Mr. Stevenson is a grown man living in a family situation. He earns $60,000 per year and pays 25% tax. Now tax is an amount of money that he gives to the government. Now every single time he gets his salary in his paycheck, he has to give that to the government. And the reason he gives it to the government is to pay for all the things that happen in the community. Things like the repair of the roads, water supply to your house, even things like the garbage man picking up the garbage every Thursday morning. Your tax pays for that, and what's left over in your bank is something that we call disposable income, and this is the amount of money that you have to spend on things like shopping, spend on things like entertainment, even buying a new car or a new laptop. Now firstly, this week we need to start calculating, thinking about how much Mr. Stevenson has left over, because this week he's about to make a very important decision. Yes, he's about to become a homeowner. And what that means is he's about to buy a house. Now, when you want to buy a house, it's very important that a few things happen. The first thing that needs to happen is you need to obviously find a house that you like, but you need to find a house which is in your price range. Now, you can imagine that if Mr. Stevenson earns $60,000 per year and a house costs maybe $1 million, he's going to have to save a lot of money until he can afford to buy that house. And that's where the next part of this situation comes in. You see, Mr. Stevenson is not going to save up all of the money to buy the house. He's going to take something called a mortgage. Now, a mortgage is where he walks into a bank, one of the biggest banks in the country, and he might sit down with the bank manager and start to tell him his financial situation. Now, as you know, there are many banks that you can go to, and each one of those banks will offer you a mortgage. A simple word for a mortgage is a loan. Now, when you borrow some money from the bank, you have to pay it back. But the way that the bank makes money is you have to pay it back with something called interest. And interest means you have to pay them back some extra money because you borrowed it from them. Now, different banks have different interest rates, meaning that some banks want a small amount of money back and some banks want a large amount of money back. Obviously, what we want as human beings is to pay the smallest amount of money to the bank, so we would choose the smallest mortgage. Now this week, Mr. Stevenson is going to visit 3 banks, and he's going to analyze, and you are going to help him to look at those interest rates. But there is more at play here than just the interest rates alone. You see, some of the small banks don't have any branches, which means you can't walk into the bank and talk to somebody physically. It might be on the telephone, or maybe you can only communicate via email, and they might have a very small or low interest rate. Whereas some of the big banks that have buildings and all of the chairs and bank managers that you can walk in and talk to at any point in time, they might have a higher interest rate. So this week, Mr. Stevenson is trying to decide, does he want to take a lower interest rate with a worse service, or a higher interest rate with a better service? But there's more than that at play. Can he even afford to get a mortgage? Maybe he hasn't got enough disposable income. Maybe he can't save up the deposit, and maybe it's actually not the right time to buy a house at all. Now this week, you have to put yourself in the shoes of Mr. Stevenson. We're going to give you some information about him, and then we're going to ask you to make a decision. You're going to get together with your friends, with your peers, with your class, analyze all of the information, and you're going to help him make a decision that suits him. Now remember, the tricky thing about financial fundamentals is it's not just about the numbers. You see, we also want to look at the ethical, the moral side of this decision. You see, some banks may be investing money into something called fossil fuels, which is not really sustainable. But some banks may be investing in solar energy. So this week, there's a lot to work out Is it about the numbers? Is it about the reputation of the bank? Is it about the service that they provide, Mr. Stevenson? Because in the future, when you have saved up a deposit for a house, you will also have to go out there and find a mortgage that suits you. And this is the idea behind Financial Fundamentals. We want to prepare you for tomorrow so that you can be ready for all of these financial quandaries that are coming your way. Good luck with this week's Financial Fundamental, and we'll see you all next week.